Greetings and welcome back to our fourth section on Module 8. We're going to be talking about stock splits, stock dividends, and give some analysis on how we really analyze these things. Now, if we're looking at dividends and splits, you start saying, well, didn't Tesla, Amazon, even Apple not too long ago have stock splits, maybe a 3-for-1 stock split, 2-for-1, 5-for-1? Those are stock splits where your original stock was trading at $100 a share. Now you got 5 shares trading at 20 bucks a piece. So you're reducing the purchase price, which is kind of nice and easier to access, but you still have the same ownership percentage. So those cash dividends you get are not really affected when you look at that. So let's take a look at dividend payout and some ratios that go with that. So our payout ratio, we have common stock dividends per share. So maybe we send out $20 in share dividend, and we had $100 in earnings per share. So we paid out 20% of our earnings as dividends. By the way, do all companies pay dividends? Well, most high-tech companies don't pay dividends. They actually try to hold on to the money. They retain the earnings, hence the term retained earnings, but they will then ultimately invest it in buying other companies or building out other activities or investing in new businesses, new arenas, new areas. So you may not want any dividends from that company. I sometimes ask my undergrads, hey, would you ever invest in a company that doesn't pay dividends? And the more engaged and aware say, sure, I'll make my money on the stock price when it jumps up. I don't need to take out dividends. But some people like to see the steady dividend payouts, and that's okay too. Dividend yield is a common stock dividends per share over the current share price, not the earnings. So that's our dividend yield associated with that. So cash dividends reduce both cash and retained earnings. Remember retained earnings, we have that add net income, deduct dividends. Well, here we're deducting dividends. That's going to reduce our equity, reduce our retained earnings. When we declare, we're going to pay out some monies. We're going to pay out some dividends. It never, ever, ever shows up on the income statement. The only type of dividend is when you get dividends from another company. So if you bought a utility or a bank stock and they paid you dividends, yeah, you get some dividend income, but you never take dividend expense. Well, why is that? Well, think about it. IRS would not like that at all. Let's take a quick look at what we could do if we could declare dividends on anything we wanted and have zero net income. Okay, we had this previous screen, and I kept that there. We're going to go back to that in a little while. But let's say we have a net income. We'll start with sales of 100 million. We have expenses of 90 million. And we have net income, you guessed it, 10 million. What happens if you could put this on the income statement? Oh, I'm going to pay my dividends of 10 million bucks. I'll go out to my stockholders. What's that going to do? That's going to leave a big fat zero for the IRS to collect on your percentage of income that's taxable. You can't deduct dividends on an income statement. So bottom line, be aware that it's a nice thought, but it's not going to happen. The IRS would never allow that, and it makes sense. That's why with corporations, we talk about double taxation. You get taxed on the net income, and then you get taxed on the dividends you receive when you own stock. When you're there. All right, let's go back to our previous screen. Take a look at our PowerPoint. So we do never take dividends on the income statement, but they do reduce retained earnings directly. So dividends on preferred stock have priority. We've already talked about that over common stock, including unpaid prior years if the cumulative feature is written into the paperwork. They collect the dividends in arrears. That's last year's and previous year's dividends that were never declared, but I get, as a preferred stockholder, the rights to accumulate those as we go. And this happens to be 8% preferred stock, $50 par. And so bottom line, $4 a share, 8% of the 50 will be given to the preferred stockholders each year. And since this is cumulative, next year they'll get up to $8, and then the year after up to $12 for every $50 par issue. Let's talk stock splits. So 2-for-1 stock split. I mentioned that at the beginning of this presentation. So if we had 100 shares outstanding and issued, and we did a 2-for-1 stock split, we now have 200 shares, which represents the same 100% ownership. So originally, if you had 1 share, you own 1% of the company. Now, if you have 2 shares and there's 200 out there, you still own 1% of the company. So your ownership interest hasn't changed. You didn't get any money either. You didn't get any cash. You just had new stocks issued. So stock splits are usually prompted to desire to reduce the stock price. So if you're at $2,000 a share and you do a 5-for-1 stock split, you're now down to $400 a share. But you have 5 shares for every one you had before. Includes marketability, awareness, access. You ever look at Berkshire Hathaway, they're typically between $350,000 for 1 share and $450,000 for 1 share. They also have a Class B stock, which is closer in the $300 to $400 range, sometimes $250 to $450, I guess. So there is different classes of shares, but Class B probably don't have the same ownership rights, interest rights, and profitability rights that Class A would have. Stock split has not a monetary transaction as such, so there's no cash. There are no direct dollar financial statement effects, but there is a number of share effects. So if we do a 2-for-1 stock split, that 100-share example, we now have 200 shares issued and outstanding. It would say that on the balance sheet in that equity section and isolate that. So the financial statement is not affected dollar-wise, but it is affected number of shares-wise. And they must disclose the number of shares outstanding for all periods presented in a financial statement. So we need to look at last year's and this year's, reflecting the split. Additionally, the company must reduce the par value. So our par value got cut in half. We went from 100 shares to 200 shares. And historical financial statements presented with the current 10K must be adjusted likewise. And then the final slide on the dividend section and on the stock split section. We can also, as a company, declare a stock dividend, where shares of stock are distributed instead of cash. So it's almost like a stock split, only there's some different accounting that goes with that. So the company reduces retained earnings, just like a cash dividend, and increases additional paid-in capital, contributed capital. But this par value is not changed. And again, there's no cash that changes hands. So many companies will declare a stock dividend, then a stock split to avoid the reduction of par value. Then is described as a stock split effected in the form of a stock dividend. Still the same effect. You now have 2 shares for every one, but there's an internal accounting mechanism that is different in the process. So we'll go ahead and conclude this module, and then we'll go onward and upward into the next. I'll see you shortly.